Hello everyone, this is Nader again, and today in this video we'll continue what we started in the last video on how we are analyzing the financial statement and what ratio that we need to know. So let's start. So in this video we will continue with three main category or three main accounts or analysis that you need to look for. So the first one will be the debt ratio, which is the total assets divided by the total liability. So this ratio indicate what portion of the company assets it's financed by the debt. That means the loan that you are taking from the bank or whatever. So there is two main category to finance your operation or to finance your assets, either the debt, either the equity. The debt, it will increase your financial risk. Why? Because you have interest that you need to pay on regular basis. However, if you finance your assets through the equity, you will not have any financial risk or financial leverage. So again, the debt ratio indicate what portion of the company assets financed through the debt. A high debt ratio may indicate a higher financial risk. If total liability are close to total assets, the company may over leverage, which could lead to solvency issue in the short run. If we took a quick example, so if we have the total assets 1 million and the total liability is 700,000, it means that the debt ratio 30%. So the company is finance their assets using the loans or using the debt 70% of the assets, and 30% are financed through the equity, which again it will increase the financial risk or the financial leverage. Second account that we need to look for is the intangible assets versus the total assets. A high portion of intangible assets, which is the patents, the copyrights, or the goodwill related to the total assets, can indicate that the company rely heavily on the brand name or the brand value. While intangible assets can be valuable, they can also be hard to quantify or qualify, and may present financial risk if the company is not performing well. If we took a very quick example, if we have the total assets 2 million and intangible assets are 800, so the percentage of intangible assets to total assets are 40%, that means that the company is relying heavily on the intangible assets or the goodwill, which may be difficult to value, and it may be having a huge risk if the company is not performing well. And the last analysis or the last thing we have in this session is the cash flow from operation versus the total liability. We know that the cash flow statement have three main category: cash flow from operation, cash flow from investing, and cash flow from financing. Cash flow from operation, it's represent the cash in or cash out from the main business of the company. So comparing cash flow from operation to total liability can provide insights into the company's ability to cover its debt using the cash that's generated from the corporation. If the cash flow from operation is low relative to the total liability, it may indicate potential liquidity issues or reliance on external financing. If we took a quick example, if we have the cash flow from operation 150,000 and the total liability is 900,000, mean that the portion that cover the total liability using the cash flow from operation is only 16.7%. Low operation cash flow relative to liability may indicate a liquidity issue or liquidity concern. So just a quick summary of what we discussed during this video. So we have discussed the debt ratio, which is the assets versus liability. And again, this will show you if the company has any financial risk or financial leverage. Intangible assets versus total assets, which again show you if the company is relying heavily on the brand name. The cash flow versus liability, which again it will show you if the company have any solvency issue. So again, you need to look beyond the numbers in the balance sheet, income statement, or in the cash flow. You need to compare the accounts so you can understand what's going on in the company, what's the risk or the challenge that the company has, and how to fix it. So see you in the next video. Thank you so much.